Corporate finance practice problem using OneNote. Calculate change in cost of debt after tax due to a reduction in tax rates. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're going to be in the icon on the left-hand side in the practice problems down here in the 1120 calculate change in cost of debt after tax due to reduced tax rates tab. Note when using OneNote, take a look at the immersive reader. Many of the presentations up top will be mirrored down here in the text area, same name, same number, with transcripts that can be translated into multiple languages, either listened to or read in those languages, thereby good complement to the presentations. Closing icon up top, then we have our information on the left-hand side we'll use to calculate on the right-hand side. Remember, as we're going through these practice problems, we're focusing in on the financing of the company. So you're keeping in the back of your mind the idea that you want the money to finance operations of the organization, which we can get in two major categories or classes. One, debt financing. Two, equity financing. When we focus in on the debt financing, as we are here, we need to take into account the added consideration of the tax impact, especially if we're going to try to compare different financing options to, say, equity items, which do not have that tax impact related to them. So we're going to have the cost outstanding. We have the bond. We're going to have a bond. We're issuing the bond. And then we're going to imagine a situation where circumstances have changed and see what the difference would be if we issued the bond at a different time in the future. So we have the bond outstanding. We're going to say is 9%. 9% on the bond. We're imagining that being the rate on the bond. Yield to maturity, or the market rate, the demanded rate of return. Yield to maturity 12%. That not on the bond. The tax rate is going to be the 35%. Remembering when we think about the tax rate, we might be thinking about the tax rate on the margin, even though we have a progressive tax system, therefore taking basically the highest tax rate, because that's where we're kind of at this point in time when we make a new decision. Then we have the after-tax cost of debt. That's what we're basically going to be looking at. And we're going to assume the par value. Once we do the calculation with just basically percents, then we'll do another calculation with the par value so that we can basically think this through with actual dollar amounts. Then we'll do another one saying, well, what if the tax rate changes to 25%? And what if there then is a change in the market for the yield to maturity to change to 10%? What would then be the impact or the cost of debt at that point in time if we were to take out new debt at that point in time? So it's going to be a great problem. Here we go. The cost of debt after taxes, we're going to be considering it first on a percentage type basis, straightforward like the other cost of debt type of calculations. The only thing different with the bond is that we're considering the interest rate, not the rate on the bond, but the market rate. You got to pick up the market rate. That could be a little bit confusing because you're probably thinking, hey, look, when I pay the annual interest, I'm paying at the rate of 9%. Why am I picking up the 12%? And once again, kind of like the average between all the payments is going to be the 12%, because in this case, given the fact that the rate on the bond is less than the rate on the market, you would expect that we issue the bond at a discount at that point in time, because the people can get basically a better rate elsewhere. So for us to sell our bond, we would have to sell it at a discount. That difference between the discount and the par value is basically due to interest. And from an accounting standpoint, we would actually then expense that interest over time. So it could have then a tax impact. So it still is something. So on average, you can kind of think of it as the market rate as being the actual kind of rate that is the cost given those components, and there will be a tax impact for it. Then we're going to take the 1 minus the tax rate. So 100% or 1 or 100% minus the tax rate, which would be 0.25 or 35%. And that's going to give us then the 65% or the 0.65. Then we take the 12 and multiply it times the 0.65 to get the 7.8. So remember, 0.12 or 12% times the 0.65. It's going to give us the 0.078, otherwise known, if we move the decimal over, 7.8%. So that would be the cost, and we can kind of compare that then to other types of financing options and get some kind of good estimates between them as we take into account the taxes that will be impacted. Note, though, as we do that bonds, of course, do have an expiration date and whatnot. So it's still kind of a little bit difficult to think about the different options between equity and debt, but that's going to be our idea here. Now, if we actually add in the $1,000 and try to calculate this out, this makes more intuitive sense oftentimes to people to say, hey, the percent makes sense kind of, but let me put in some numbers here and calculate it again with an example. Look something like this. Interest calculation would be the 1,000 times the 12%. Going to multiply that times the 12%, which is the market rate. Once again, you're going to say, hey, but I'm not really paying 12%, and I'm paying 9%. That's how much the interest is going out. But as we amortize the discount or premium, whichever the case would be, we have to basically, we will have an impact of the difference, and which is a result of a difference between the price and the par value, or the amount that we're going to pay at maturity. So that's why, on average, we're kind of using that 12%, even though it's a bond here. So the 1,000 times the 12% means the interest would be on average the 120 per year. And then we have the tax benefit of that would be the interest deduction, because now this would be good for taxes, of 120 times the tax rate, or 35%. 120 times 35 means basically of this 120, we're going to have to, in essence, pay. We're going to get it back in terms of taxes of like 42. So 120 minus 42 is 78. Cost of debt after the tax impact. Then if we want to get back to the percent cost, we could say, well, then let's take that 78% and compare it to the debt, the 1,000. And that then 78 divided by 1,000 would give us that 7.8%, 7.8% that we got in this format up top as well. So obviously you want to kind of understand this formula, basically, which is the market rate, or the rate of the debt, which in this case, if it's a bond, market rate, times 1 minus the tax rate. You want to understand that, so you can go to do a nice quick calculation. Often useful, however, to then work out the example and calculate it in this format, useful for your own understanding, and often useful to basically show someone else's understanding of it as well. So then we could say, well, what would happen then if there was a change, and now there was a tax rate change to 25%? So that's good. So we look better there. And then the rate, the change in the yield, meaning the market rate on the bonds, is now 10%, even though the bond, we're still saying, has a rate of the 9% on the actual bond. So then let's do the calculation on that change if we were to do like financing again in this time period. So now we're going to say, what would financing cost at this time? Also note that when we're actually generating the bond, if we're generating a new bond, we might try to match the market rate here, which would be, in this case, the 10% as we generate the bond. Once the bond's generated, of course, then the rate on the bond will differ after some time passes to the market rate. But for a book problem purposes, we want to basically make sure that we understand when we're trying to present value, when we're trying to see the cost, we're picking up the proper rate, which typically will not be the rate on the bond, but the market rate, and due to the reasons we basically talked about. That's kind of the tricky thing with the bond side of the debt financing. Okay, so if we know that, then we're going to say, all right, well, then we just take the interest rate, which is now the 10%, if we wanted to issue and finance with some bonds here. And then we're going to take the tax impact, 1 minus the tax rate, 100%, or 1 minus the tax rate, 0.25 or 25%. That gives us 100% minus 25%, 75. And then we take the 10% times the 75. That gives us the 7.5%. Remember, this calculation right here, it might make some sense to kind of mull it over in your mind. It'll be easier to remember. This 100%, you can kind of think of the change in the net income, the taxable income, which is going to be taxed. And then 25 of it, you're kind of getting back. Therefore, the 75% of it will be the actual impact times the rate, which is the 10%. That's giving us that 7.5%. Therefore, 7.5% is the cost we're thinking after taxes, as opposed to the 10%. So if we were to compare this to something else that doesn't have a similar tax impact, such as not debt financing, but rather equity financing, then we could try to compare something that's more matchable. Apples to apples, as they say, same thing to the same thing is what that means. So now we're going to go to the example down here, and let's just plug in our $1,000 par value and just work this out again and look at it this way. The debt would be 1,000, we're going to say, and that's what we would get because we're issuing the 1,000. We're going to receive the 1,000 we are imagining. The cost is going to be 10% in terms of interest. We're not actually paying 10%. We're going to imagine we're paying the 9% here, but using the market rate because of the fact that we would have to issue this time the rate on the market is 10%. It's still higher than the rate on the bond, and therefore we'd still have a discount, and we'd have to then account for that discount that we give versus the maturity date is due to the difference in rates. So and we'll amortize the discount, so we'll have a tax impact of it, and so on. So that's why we're using the market rate. So 1,000 times the 10%, $100 tax impact on average for the life of the bond here, which does have a maturity date, which is a little different than possibly equity kind of methods here, but we've got the 1,000 times the 20 or 100 times the 25% because this interest deduction is like a deduction, and tax rate 25%. So $100 times 25, tax benefit of 25. So of the $100 that we're going to have to pay basically on average over the life of the bond here, we're going to get back in terms of tax benefits $25. So the net impact being 75 cost of debt after the taxes in terms of dollars. But we want the percent because then we can use the percent to calculate. So we can then just say, let's take that cost of debt after taxes, the 75, compare it to the original debt, what we got, which is in this case, 1,000. 75 divided by 1,000 is 7.5. 7.5, same calculation then we got up top, the 7.5. Now on a percentage basis, taking into consideration the tax impact, something that could be more plausible, easier for us, better decision-making process if we compare to something that doesn't have the tax impact. Just note, by the way, if we're comparing obviously debt to debt kind of calculations, it's not quite as important, of course, because both of those have a similar kind of tax impact. So it might be worth doing in that case. But again, if you're comparing to other types of financing that don't have that same tax impact, such as equity financing, that's when it becomes a little bit more difficult for us to do those kind of comparisons between different types of financing. We're looking for ways to make that comparison, to make that decision easier.